In this week's video, we'll cover numerous shifts that will impact investing and portfolio construction for years to come. We'll be moving quickly, so feel free to use the pause button on your video player. Chart in the upper right-hand corner of your screen is a daily chart of the S&P 500. After the labor report, S&P 500 gained 18 points and finished the week in the green as well. And we've also printed a higher high on a closing basis by exceeding the high from late July of this year. A shorter-term look on the chart of the S&P 500 is slowly morphing back into a full-bore bullish look from a trend perspective. In mid-December 2023, TLT, the 20-year Treasury bond ETF, remains 40% below the August 2020 high, telling us in no uncertain terms the world of investing is significantly different in 2023 relative to what we've experienced over the past 30 to 35 years. Let's start with the fundamental drivers of inflation. In the 1980s and 1990s, globalization was a big driver of economic growth, and increased efficiency and lower labor costs helped drive down inflation. And in this period, for the most part, trust between nations was trending in a positive direction, and we had a prolonged period of relatively low and stable energy costs. Fast forward to the 2020 to 2023 window, and in the wake of a global pandemic, and maybe more importantly, increased aggression from Russia, global trust is arguably at the lowest point that we've seen in decades. After being burned by supply shortages, companies are interested in bringing their supply chains closer to home. And in terms of inputs, energy and labor costs, both on the upswing. And when interest rates were artificially suppressed by global central banks for long periods of time, there was an incentive to load up on low-interest debt. And all that debt in the system, including the debt driven by U.S. deficit spending, that can also add to inflationary pressures. When inflation is rising, fixed income investments become less attractive, and thus, it's not surprising that interest rates have broken their long-term downtrend. There's been a lot of indecisiveness in this window here, and that's caused a lot of volatility in the asset markets. And that volatility has been with us for quite some time, possibly dating back to 2011. With the 10-year yield breaking above this trend line now 4 times, 1, 2, 3, 4, and then making a higher high above this high, the observable and significant changes on the chart of the 10-year yield tell us that portfolio construction, asset allocation, and investing in general will probably be significantly different walking forward. A lot of the relationships and correlations that investors grew accustomed to in this window here, they may not apply in an environment with a bias towards higher interest rates and higher inflation. A balanced portfolio of stocks and bonds has the wind at its back when the bias is for lower interest rates. Thus, the changes we're discussing here represent a significant shift for all investors and money managers. And the fact that TLT is still 40% below the August 2020 high tells us we have to be open to the fact that this may be a lasting shift, an irreversible shift. And the concepts of lasting and irreversible also align with the performance of traditional safe havens in the 2022 bear market. Top portion of your screen here and here, asset class performance during the dot-com bust bear market. During that bear market, the max gain for TLT at one point was 38%, IEF was 41%. If we go to the financial crisis in the middle of your screen, safe havens acted as safe havens. The max gain for TLT in that bear market, 46%, IEF almost 26%. In 2022, TLT and IEF lost money right out of the gate and were never profitable during the entire calendar year. And gold acted as a safe haven for a relatively short period of time, but when we look at the full year returns, not particularly impressive. So all of this tells us that we have to be willing to embrace change rather than fight it. Here's another chart that reinforces all of the concepts that we've covered thus far. For the most part, this is SPY divided by TLT. We're using mutual funds because they have a longer-term track record. In this window here, beginning with the peak in the stock market in the year 2000, really all the way out to 2021, this 22-year period is an excellent period to be a balanced fund investor, especially from the perspective of smoothing out volatility. In a world where fear of deflation was the primary concern of central bankers, government bonds not only helped smooth things out, but they offered wonderful profit opportunities during bear markets. If the trend on your screen is going to continue, stocks outperforming bonds, it can't all be gloom and doom. And this shift in interest rates speaks to a greater demand for goods and services and for capital. And these shifts that we're seeing have been and will continue to be impacted by increasingly favorable demographic trends in the United States. The millennials overtook the baby boomers in 2019 as America's largest generation. And from an economic standpoint, that's relevant. Between 1988 and 1994, the median age of the baby boomers was 36 years old. Economically, what did that mean? It means in this window here, where the median age was 36 years old, as we marched forward in time, more and more of the baby boomers were moving into their peak earning and spending years in that age 35 to 54 window. And in that window, you have a tendency, because you're more productive, to produce more than you consume, which means you have capital to invest and you have a lot of discretionary income. So where do we stand today? 1988 to 1994, median age of the baby boomers 36. Present-day millennials are in a very similar spot. Between 2022 and 2027, the median age of the millennials will be 36, just as it was for the baby boomers between 1988 and 1994. And much like the baby boomers that can be split into the baby boom generation and Generation Jones, demographically, we have a double boom coming sometime in the future. Largest generation, the millennials, currently the second largest generation, Generation Z, right behind them. Generation Z is eventually forecast with immigration to overtake the massive millennial generation, telling us just how big these two generations are. And much like the double boom in this window over here, walking forward from 2023, we're getting an overlap between those generations. The oldest members in 2023 of Generation Z are 26 years old, entering the workforce and helping the older millennials between 27 and 42 years old to be even more productive. Thus, between 2023 and the end of 2034, based on people that have already been born, there's going to be a significant economic tailwind. And typically the older generation, the boomers in this case, become a drag on the economy. But there's also some stimulative offsets with all of the money that they've been socking away in IRAs and 401k plans. And since they'll be forced to take money out of those plans based on their RMD schedules, some of that money can be stimulative for both the economy and the financial markets. And history tells us that these favorable economic tailwinds could result in a continuation of the current secular bull market in stocks into the mid-2030s. And as we did in detail back in June, and you can find it by Googling the title here on your screen, we can make a very rational argument that the present day is similar to this window here in the mid-1950s, and this window here in the late 1980s, early 1990s. And as you can see here with the favorable demographics, the secular bull lasted for a very long period of time. Similar situation back here. The secular bull market lasted arguably until this peak in 1968, and even this higher high here in early 1973. How is it possible the present-day bull market could last until 2035? This is a big part of that answer. A lot more information on this topic is available on our website. And from a pattern recognition standpoint, it's pretty easy to see that this orange box here, this orange box here, and this orange box here are discernibly different from the secular trend windows between 1950, end of 1968, 1982, into the year 2000. And it's also fairly easy to see from a pattern recognition standpoint that the present day trend in 2023 looks a lot more like this and this relative to this, and this. And as long as that's the case, we want to err on the side of remaining invested. If we examine these figures objectively, examine this chart objectively, and the concept here in the black box objectively, and couple that with these known major macro shifts, it's not an exaggeration to say that we're in a different world from an investing perspective. It's a monthly chart of the 7 to 10-year Treasury ETF, symbol IEF, going all the way back to its inception date in 2002. As long as price stays below these long-term, anchored volume-weighted average price lines, it's easy to understand how we could be in a different world. If this downtrend can be broken and price can move back above all of these colored long-term anchored volume-weighted average price lines, that would probably make things much, much easier for everybody from an investing perspective. It will be helpful for both stocks and bonds. But this is the chart in front of us currently, which dovetails nicely into a logical question. How could the present day be similar to a secular trend window between 1950 and 1968, or a window between 1982 and 2000, if the long-term trend in interest rates has shifted from down to up? Well, as we've discussed in the past, in this secular trend window here, 1950 to 1968, investors were also dealing with a significant increase in interest rates. 1950 here, 1975 here. And that was not a showstopper for the bull market on the left side of your screen, which looks very similar to the bull market on the right side of your screen. But given that this bull market featured a long-term downtrend in interest rates, and this bull market featured rising interest rates, it's probably fair to say that we would give this window the benefit of the doubt. If we were to examine the current secular trend to date, it's tracking somewhere between this window and this window. And that's relevant because this window featured very little in the way of volatility relative to this window. So if we're going to try to invest in the different world, and we know interest rates have been rising in the present day, and we know interest rates were rising in the 50s, probably makes sense to understand how to invest successfully in this window. And if the next 12 years turns out to be more like this window, then it would just be a little bit easier. And the reason why this secular trend is important, because as long as the secular trend is intact, the bias is going to be for the market to eventually make higher highs after bouts of volatility. Thus, it's prudent to have a way to monitor the secular trend. So let's focus on this window here. And in that window, from this low in 1953 to this high here in early 1973, the S&P 500 gained 429%. Once again, telling us to keep an open mind about better than expected outcomes over the next 10 to 12 years. This is a very appealing number up here, but in an environment with rising interest rates, that also typically comes with increased volatility and larger drawdowns. So if we're trying to navigate between this point A and this point B, we have to understand how we're going to handle these periods where the drawdowns can be very significant. And when the secular trend ends, they can move from very significant to very damaging and painful. So we want to have a prudent way to deal with this, and maybe most importantly, this. Because walking forward, it's possible that experience could end up hurting some investors rather than helping them. Now, that can be offset and allow you to leverage your experience as long as you're willing to be flexible and as long as you're willing to adjust to a new environment. And for us, more specifically, what that means is the market model, still very, very useful. Regardless of what interest rates are doing or what inflation's doing or what the Fed's doing, trends are trends are trends. But we also have to acknowledge, and maybe more importantly, adjust to some of the changes that are happening around us. Example, asset class correlations, asset class behavior, risk-on behavior relative to risk-off behavior. Probably fair to say if we look at the numbers on your screen here, the different world concept would apply. Now, as we've discussed in these videos in recent weeks and months, we've already made significant progress on this front here, with methods to help us discern between these blue boxes and these orange boxes within the context of a secular trend, and help us discern between the healthy portion of a secular trend and when that trend may be in jeopardy of ending. And it's important to be able to address this question in an objective manner, because from a probability perspective, if it still looks like a secular trend, when you're managing through a drawdown, you're doing it in the context of a secular trend. And secular trends eventually go on to print higher highs. But a strong trend can't last forever. It's pretty easy to see that the look of the trend here is discernibly different from the look here, discernibly different from the look here. And the increasing frequency of the trips into this moving average envelope tell us that this trend is becoming more vulnerable to rolling over. There's a subtle but discernible difference between the green box and the blue boxes. And this drawdown here in 1970 is telling us the secular trend may be in jeopardy. This looks discernibly different from anything in this window here. And that's relevant because this speaks to a change in human behavior and speaks to a different interpretation of the relative importance of the positive economic drivers and the negative economic drivers. And the look of this drawdown here in 1970 becomes even more helpful and more relevant when we breach the moving average envelope again in 1974. These discernibly different looks speak to a shift in the market's tolerance for risk. And this is relevant because this look here and this look here eventually morph into the 1973-74 bear market that saw a drawdown of almost 50% in the S&P 500. And this red flag here and this red flag here turned out to be helpful because the additional drawdown from this point here, a backbreaking 28.76%, and that's in addition to the drawdown between this point A and this point B. Now, while we've addressed this question in some form, and this question in some form, we've been doing a lot of additional work behind the scenes to help us answer these questions as well. Are the odds of a larger drawdown increasing? And that's relevant because all things being equal, we'd like to mitigate a drawdown of this magnitude. Mitigate a drawdown of this magnitude would apply here, here, and obviously here as well. And if we're going to use some additional tools to address the concept of a different world, we want to have a high degree of confidence that the data and the approach that we're using, that they're helpful, that they're relevant. This is a zoomed out look, a 25% zoom of a portion of the secular volatility model, and gives you a feel for the type of analysis that we've been doing to help us answer the primary questions and the additional questions. And in the end, all of this is going to help us answer this question: are investment allocations in line with the evidence? So hypothetically, if we're trying to navigate between a point A and a point B that could be several years down the road, between point A and point B, are we taking a reasonable and prudent amount of risk relative to the data in front of us? So let's take a look more specifically relative to how the data is going to help us answer these relevant questions. The model is based on 136 daily, weekly, monthly, and quarterly charts. And it asks and answers 489 binary questions. And if we ask those questions about the present day market, it allows us to prudently compare 2023 to the 1950 to 1974 window, 1982 to 2002 window, and the 2011 to 2023 window. Now, this window includes the secular trend and the bear market on the other side of the secular trend, and this window includes the secular trend as well as the bear market on the other side of that trend. Now, we've already talked about the vulnerability score and the secular trend score. And during development and in recent videos, we've been referring to those scores, the vulnerability score as score A and the secular trend score as score B. And the vulnerability score helps us answer this question: how strong is the trend within the secular trend? Do we look more like the blue boxes, or do we look more like the orange boxes? And the secular trend score, previously referred to as score B, helps us answer this question: does it still look like a secular trend? And the answer to that question is going to impact how we manage a drawdown. We don't want to manage a 10% drawdown in the same manner as we would a 50% drawdown. When you're trying to address any problem or assess probabilities, you'd prefer to look at the data from different perspectives, to come at the problem from different angles. And by doing so, it can help us answer this question: are we comfortable with the data and the approach? Said another way, do we feel that the vulnerability score is going to add value? Do we feel like it's been modeled properly? Is it producing results that intuitively make sense? In this portion of the analysis, we tried to answer this question, looking at the problem from a different perspective, and as a result, we were able to model 2 additional scoring systems. The vulnerability score looks at the problem from this perspective. If I look at the state of the market or the state of an indicator at a particular point in time, and I do so in the context of a stock market drawdown, when that indicator triggers or moves from a 1 to a 0, how helpful was it? And from this perspective, we calculated what was the additional drawdown after the signal was fired. How useful was it? If the additional drawdown is 10%, it's pretty useful. If it's 2%, not particularly useful. Broad A and broad B, look at the problem from this perspective. If I'm trying to reduce risk in an incremental manner during this drawdown, is the indicator chart or signal helpful in a logical manner? Can I see a logical progression between a 5% drawdown, a 10% drawdown, a 20% drawdown, a 30% drawdown, all the way out to a 50% drawdown? And another way of looking at it, does this particular indicator help me discern between a 20% drawdown and a 30% drawdown? If the answer is yes, it's useful. Is the indicator broadly useful during a drawdown? So you're using the same data set, but you're looking at it from a different perspective. And in this case here, broad B, only 92% of these questions were relevant. About 8% of them had to be thrown out. So when we look at the results that we have thus far, the fact that this score, and this score this week are all similar, that's a good thing. That's telling us that what we've seen thus far, we are comfortable with the data and the approach. The scores are logical and they intuitively make sense. The secular trend score helps with this question here, the first question. The vulnerability, broad A and broad B, they help with this question, and in some ways, this question. But we also wanted to develop something that will help us understand, thus far, what we've seen. Does it look more like a typical 0 to 5% correction, 5 to 10, 10 to 15, 15 to 20, 20 to 30, or 30 to 50? And all 10 of these scores can help us with the primary question: are investment allocations in line with the evidence? The scores on your screen are from Thursday of this week intraday. Now, logically, if we compared the scores from this week to the scores at the October 1974 low, we would expect them to be significantly different, because there's been a lot of incremental and observable deterioration between point A and point B by the time we get to October 1974. So if we compare the present day scores to October 3rd, 1974, it makes sense. Tells us the model is operating as designed. This score says you've been highly vulnerable for quite some time. Incrementally, you should have already stepped out, and it no longer looks like a secular trend. And over time, as these figures here rose from low levels to much higher levels, the data's been telling you incrementally over time that you should be getting more and more concerned about a potentially large drawdown. Thus, we really don't need to cover a lot of charts from this week to help us answer this question. These scores range between 0 and 100, and these scores range between 0 and 100. In terms of these top 4 scores, higher scores are a sign of strength and lower vulnerability. And relative to the bottom 6 scores, lower scores tell you you're not particularly at risk of this type of drawdown. Conversely, when we look at the scores in October of 1974, lower scores, the top 4, speak to vulnerability, and higher scores in the bottom 6 speak to being more susceptible to this type of drawdown. Hence, the scores from Thursday of this week, if you're a stock market bull, this is what you want to see. High scores in the top 4 and low scores in the bottom 6. There's nothing magical about any of this. It doesn't predict the future. It simply helps us assess the probability of good things happening relative to the probability of bad things happening, and it allows us to do it from multiple perspectives and on multiple time frames. Things may look bad here near this low in 1962, but within the context of the secular trend, it's much, much easier to keep an open mind about better than expected outcomes when the market starts to rally. And as we noted last week, when we compare the present day to these concerning developments in these bear markets, and then compare the present day to the looks and data after the major low, it's easy to see that the present day correlates and looks a lot more like the favorable periods after the bear market was over and after the major low was in place. To summarize, on Friday, December 8th, the facts that we have in front of us today, facts that allow us to take an objective look at the markets, tell us to keep an open mind about better than expected outcomes looking out days, weeks, months, and even years. And on Friday, December 8th, if we look at the questions in the lower right-hand corner of your screen, the S&P 500 is above an upward-sloping 200-day moving average. The 20-week is above the 30-week. The 30-week is above the 40-week. The slope of the 50-week is up. Price is above the 200-week, and the slope of the 200-week is up. The same can be said for the 50-month. Price is above, and the slope is up. There's nothing here, nor anything here in the lower right-hand corner that contradicts any of this, or this. Thus, given what we know today, from a long-term perspective, the bias will most likely be for higher inflation, higher interest rates, in the context of favorable and improving demographics in the United States. All things being equal, we would much rather have supply issues relative to weak demand. And we would much rather be concerned about a monthly labor report that was possibly too strong relative to a labor report that was too weak. Tighter labor markets are a good thing for workers. And bringing production and supply chains closer to home is good for the middle class. But many of these major shifts could result in a long-term drag on the performance of balanced portfolios, that being a diversified mix of stocks and bonds. The last couple of years have been difficult for investors, but if we're willing to learn from that, and we're willing to accept the changes that are clearly in front of us, and we're willing to adapt, given what we know about secular trends and given what we know about demographics in 2024, the opportunity in the stock market most likely is much better walking forward than most believe or expect. And with the new tools that we've developed and the adjustments that we've made, a bright investing future is possible if we're willing to adjust, tolerate higher volatility, maintain a longer-term focus, and do all of that as long as the data allows. And we all know the only way that's going to be possible is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.